This is the headline that's garnering all the attention today.
All the evidence shows there's a investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. This is A Steward's View. So glad you joined us again. You can visit this week's economic and market roundup at astewardsview.com/blog. Today on ASV, we'll catch you up on some of the details and the why behind moves in global markets in recent days, including today's impressive equity moves and the unimpressed bond market. As usual, we'll integrate the economic, investment, and planning points of knowledge to add to your decisions. Okay, and then we do every time want to seek to add the wisdom needed for excellent stewardship. Our mission here on ASV is to help you level up your decisions so that you can be wise and decide well. Before we get going, let's take a minute. Let's examine our work in the context of God's word about stewardship. And before I begin, let me just add that Lucian Gindorf is with us, and he's stepped into some very big shoes. Mr. Chaz Louder has been amazing on this program and helped us get going the first year, and I imagine is busier than ever with his other endeavors, and so Lucian's graciously stepped in to help us in a gap and keep us moving forward. So thank you, Lucian, and welcome. Right, we won't see him on the camera here just yet, but sometime soon, we hope. So this week's passage, I want to talk about the rich young ruler. And, you know, if you've been around Bible churches at all or been in Bible studies recently, you may have heard about the rich young ruler. And there are multiple accounts of this person in the Gospels. I'm choosing the one from Luke 18 to 23, which reads, and speaking to Jesus, a ruler asked Jesus, or him, "Good teacher, what must I do to inherit eternal life?" And Jesus said to him, "Why do you call me good? No one is good except God alone. And you know the commandments. Do not commit adultery, do not murder, do not steal, do not bear false witness, honor your father and mother." And he said, "All these I have kept from my youth." He said that to Jesus. He said, "All these I have kept from my youth." When Jesus heard him, Jesus said, "One thing you still lack. See all that you have and distribute to the poor. Sell all that you have and distribute to the poor, and you will have treasure in heaven. And come, follow me." But when he heard these things, the rich young ruler was very sad, for he was extremely rich. In other Gospels, we hear about the ruler going away sad, right? So he's exiting the conversation and not choosing to follow with his heart, which is what Jesus was after, right? And so this program is very much focused on that same principle. You know, where is our heart, and how are we using what's ours temporarily to do God's work while we're here? Okay, so the major idea with a steward's view is that we're stewards or managers, not the ultimate owners of our financial picture, not the master of our own destiny, as is commonly thought. That means that our financial resources are ours for a short time, quote unquote, ours. And our decisions then can flow from that owner-manager perspective. So with that wisdom in mind, let's take a look at our core content for today. Looking at, I've done a lot in past episodes, just the past year and a half now. We started March of 2025 to kind of paint a picture of this economic machine that we're sitting in. In fact, I could add, Lucian, that our number one episodes so far is called The Economic Machine, Not One But Many, okay, from 2025. And that was kind of an older format. We've changed things multiple times to kind of streamline and take feedback. But that episode dealt with the idea that we are in this economic machine and we do have all these indicators. And so what we don't want to do is get hung up in, well, look what the stock market did. Right. Okay. And let me okay. You can't respond probably with the way you're set up, but rhetorically then, what have I added if I just told you what happened in the markets today? Okay. Is that really valuable? I'm asking. I don't think it is. That's why I'm picking on it. Okay. So the point is to say the economic machine treats stocks as one leading indicator of the economy, right? It tells us something about what's ahead. Okay. So today we'll talk about the stock market. We'll talk about the bond market. We've done that in the past, but the point of the economic machine is to say that we need to consider labor, we need to consider inflation, we need to consider manufacturing, we need to consider the consumer, we need to consider trade, right? All these topics, some are leading, some are lagging, some are, concurrent. So, to get hung up, oh, what's the headline and what did the stock market do? No. That's not what we do. We want to focus on the long run. So I'm kind of resetting that part of our conversation on purpose as we go into what happened in a major day today. So global financial markets stage an everything rally today. That was triggered by a breakthrough as to the headlines in a tentative peace deal between the U.S. and Iran. The agreement was to implement a ceasefire and reopen the Strait of Hormuz, causing oil prices to plunge to a 2-month low, sparking major gains across global equity markets and cooling short-term inflation fears. So the S&P 500 advanced 1.65% in a single day, closed at a record. The Dow Jones, similar pattern, grew at 0.92% for the day, and the tech-heavy NASDAQ at 3.07 for the day. European and Asian markets followed suit, and so did Japan's. Those markets soared about 5% on this same news. So a very, very volatile pattern we've been in since this Iran conflict, this U.S.-Iran situation. I'm very proud of the fact that my firm rebalanced accounts in February, right, when asset prices were high, and I had said so in this program. And that's just to say that we were kind of reset as to our holdings, right, so that no matter what happens, then we can continue on with our strategy. Okay, and we can talk more about rebalancing in a separate episode. But very proud of that point. But we've been in since end of February, this very volatile period, right, which just means, extra up and down. Okay, yeah, and the day-to-day pattern of things. We hit a relative low last Wednesday, okay, and since Thursday, we've seen some positive moves and some broad positive moves in, kind of the major thermometer that we use with everybody else is the S&P 500, okay? It's about 24% of the world's market cap in one equity index. So that's powerful stuff. And then when you say, okay, well, Thursday and Friday, we had this kind of move off of a bottom without going into the technical indicators, we have a day like today on top of that and go, okay, wow, this is, headline or not, this is a strong pattern now that we've established. And it's not to say we won't have a down day tomorrow, but it's to say that the direction of things as we look at moving averages and we look at the rest of the year even is looking more bullish in terms of the equity markets. Okay, so commodities and energy. Let's see. So crude oil plummeted by 5%, and let's see, to its lowest level since March. The International Monetary Fund chief, and I won't attempt her name right now, she noted that the global economy is showing resilience. So that was positive. Let's talk about the Fed and fixed income for a moment. The cooling of oil prices does shift the narrative ahead of this week's very anticipated Fed Reserve meeting with a brand new chairman, Kevin Warsh. So the yield curve, what is the pattern when you look at the short term and the long term interest rates paid by treasuries, U.S. treasuries, is quote unquote bull steepening, right? So we have this short-term kind of maintaining short-term rates, and then we have the longer-term rates ticking up. Okay, and that's just fairly common with an equity spike like we had here today and even the last few days. So bonds are responding as expected, but they are, the yield curve itself, though, is steepening, which just means, it's another bullish indicator, basically, for stock investors. Okay. We're going to talk for a moment, though, about why the bond market was not impressed with what happened today. So I mentioned Kevin Warsh. He's coming in on Wednesday to the first meeting, the June meeting coming up here this week. And it's an official interest rate decision meeting, right? And there's a press conference under his leadership coming. And, economists expect the central bank to keep rates steady at 3.5 to 3.75 as to the Fed funds rate, the rate that the Fed charges to banks when they want to borrow money, right, as it relates to that institutional borrowing rate. Okay, so that's, policy language will be heavily scrutinized, but all in all, the expectation is more of the same, at least for this month. Other economic indicators, home builder sentiment unexpectedly slipped to 35, down from 37 in May, as builders reported that steep mortgage rates continued to freeze buyer activity. That's substantial. I'm sure that there are some in our community here. We could bring in Lucian over time in the real estate markets to talk more about those dynamics. I've tried to do that unsuccessfully so far, so we'll have to find. I know Wendy Seelhoff is really busy this summer, but maybe we can have her come back in addition to whoever else may be available. So, all to say, home builder sentiment is slipping unexpectedly. Manufacturing, that's contracting a little bit less than thought, so, we'll see. And I'll kind of bypass the big headline, like corporate headlines from last week and today. Jobs data. So we haven't talked about jobs for quite a while. The U.S. economy added 172,000 jobs in May. Upward revisions added 93,000 to jobs to March and April combined, resulting in an average of 114,000 jobs added per month this year. Okay, so the unemployment rate, and that's that's a lagging indicator of the economy, right? So it just tells us what's already been. That shows at 4.3%, with the number of unemployed people at roughly 7.3 million in the U.S. Labor force participation gets some attention. That's unchanged at 61.8, and that's the lowest level since late 2021. Layoffs and claims. Initial unemployment claims have remained stable, tracking around 229,000 in June. So we have a fairly stable situation there where jobs are concerned, and I'm really encouraged by that because jobs are very much a backbone of our economy. Popular conversation with both economics and politics, but it's a building block of our ability to move forward as an economy. And what we find is that all important consumer in the U.S., which is 2/3 of GDP, our economic output, the largest in the world, largest in the history of the world, right? Generating 24% of the world's economic output with 4% of its population. That's what happens in the U.S. So that consumer behavior is absolutely dependent on jobs and attitudes. So jobs are a big deal. But yeah, seeing some stability there. Glad to see that. Economic figures and inflation. CPI increased by 0.5% in May, driven by continued upward pressure on consumer goods and services. No surprise there. The producer price index rose by 1.1% in May, indicating continuing input price pressures for final demand goods. Federal analyst perspectives, headline numbers have performed better. Labor advocates highlight signs of lingering slack, while economists analyze the labor market's break-even point. Okay, that's a lot of econ speak for wait and see on how things go with labor. Well, that's true of any area of the economy. So I'm very encouraged overall by what's happening with jobs. The fact that inflation is leveling off also, it's sticky, but it's not, we're not seeing the increases month over month that we saw over the past year, okay, or year and a half now, let's say. So that's a very, very good thing in my mind. Having said that, let's talk a little bit about the bond market first. The headline I brought with me from the equity market spike today, I'll even set that aside because we've already commented on it. But there was an article in Barron's that I thought was really interesting, and I'll post this up with our content from today out at astewardsview.com. There will be a blog again. We're resuming after a number of format changes and some internal changes here. So I'm really excited about that. And we'll talk about what's coming. But that weekly blog will continue starting today, June 15th, 2026. Here it is from Barron's. The bond market is lukewarm on the Iran deal. What it's seeing that stocks aren't. This is by Martin Bakardix. Sorry, Martin, if I'm getting your name wrong. But he talked about inflation pressures from the war lingering until crude and other energy flows return to pre-war levels. So I don't know, I'll just reference the episode that we did back in April called War, the Outlook, and Aggregation, right? And I talked about, kind of a repeat of a year ago when we had the same conversation about a different conflict and what was happening. So let me make sure I don't lose my spot. There we go. So what I said in this April's episode about the war or the conflict is that we can have some short-term events with long-term consequences. All right. And that's a lot of what I'm hearing from this article. Okay. So he says, again, inflation pressures from the war will linger until crude and other energy flows return to pre-war levels. So we've had this big supply shock, right, to the downside, a constricted or a less supply of crude. So what? Well, does that automatically push gas prices higher? That and market activity, yes. But then how long does it take for them to come back down? Well, that depends a lot on what's going on in other parts of the economy. And that's this article's point. Bonds are an excellent barometer, broader investor sentiment. That's another point that he makes. And they're an early beacon for rougher seas ahead. So this week, as we see 7 of the G10 central banks making interest rate decisions, there's a hike coming from the Bank of Japan. We mentioned that. No, we didn't mention that. So yes, that's expected yet from the Bank of Japan this week. So his overall points have to do with the long-term consequences of what's happened in the short run. And he's encouraging investors to pay attention. And I'm trying to find a quote here that would kind of pull together what he's trying to say. He's actually quoting another person. Yeah, so he referenced Mark Malik, CIO at Siebert Financial, is saying the Treasury, the 10-year yield knows something that stock futures traders apparently forgot. You can't unring a bell, right? So you can't shock the economy, put out some good news, have the stocks go up and the bonds go with it, right? Bonds aren't going to, they don't move in tandem with stocks anyway. But this point is bonds are going to kind of wait and see as it relates to the situation that we have now and how they behave. Okay. So, they're going to take longer. This is now a quote from the author. They're going to take longer to reflect the uncertain nature of the U.S.-Iran agreement, okay, which appears over-focused on reopening the Strait of Hormuz, right, instead of vital issues tied to the origins of this conflict. Okay. And, that's a lot to discuss. So we'll kind of set those items aside for now. And there's also this idea that, there's a major Fed meeting coming that we've talked about. And, how is the Fed going to behave under a new chairman here in the U.S. with dot plots? Are they going to be out? Are they not going to be out? Or are we going to have forward guidance on interest rates? Or are we not going to have that? All right. So some uncertainty with that meeting yet. So the bond market's kind of hanging out right now while stocks are taking off. So we could see, this is a major point, we could see bond markets drift for a while this summer as inflation dynamics kind of clarify themselves and we have a better understanding of any impact there. And we've got the U.S. fiscal dilemma that's been going on now for years. Right at the moment, we have a ratio of debt to GDP on track to top 100% for the first time since 1946. That's with a deficit this year likely to surpass $2 trillion by the end of the fiscal year in September. Oh my. Bond markets have a lot, therefore, to process. And I thought this author was very astute in his summary. It's very quick and kind of much consensus in it, if you will. And I'll post that again tonight on A Steward's View. So, it's one thing to be bullish on stocks, to celebrate the wins, and I'm all for that. It's another thing to say, let's just look at that as a major driver of portfolios, and bonds as a major, it's not so much a price hedge with stocks, but a cushion to what happens in the stock market, especially in situations like we have right now. So the other article I'll just mention quickly, it was from Bloomberg, and this one was from Rita Nazareth. And so she said stocks climb as this U.S.-Iran deal spurs a slide in oil. And she just went into some of the metrics that we've already talked about, and mentioned that by this Friday, we'd have a complete opening of the Strait of Hormuz, according to President Trump and his meeting then that he was having when he made those comments with French President Emmanuel Macron. So this is a big deal. This whole the supply shock kind of going away when it comes to the strait opening up. We've got about 20% of global oil flowing through that strait. So to have it partially shut down in March, April, May, part of June now. I read a separate article recently where the U.S. is at an all-time low, matching the Reagan administration as to its strategic oil reserves. Right, so we've been supplementing the lower supply with our own reserves to benefit the consumer, to keep gas prices where they are, which is already higher. Right, Lucian, you've been filling up your gas tank lately. Okay, so you know what's going on there. But it's just to say, we need further clarity. We need to see this whole thing kind of, resolved, the strait completely opened, the underlying issues tackled, and then we can move forward with hopefully a more moderate kind of growth pattern the second half of this year, which has been my expectation before we had this conflict. So that's a lot without the corporate headlines that have been going on. We could spend some time on that, but this episode, I really just wanted to catch us up together on what's the economic backdrop of what's going on, and then what's happening in the markets, especially because we had such a substantial reversal in the last few days in equities and kind of a wait and see response from bonds. So with that, I don't have a lot else to add. We're trying to get going again. I do want to set the table for future weeks. Next week, we'll have an ASV Plus episode coming where we dive into more advanced investment conversation, right, to equip investors, long-term people, in their decision-making. So that's been a long promise and now a long overdue commitment that I've made to our more sophisticated listeners. And then finally, not Friday, it'll be Monday, June 29th, we'll return with Paul Larson, who is a regular ASV contributor, and he'll be back when we finally get going to finish the series called The Art and Science of Giving. So that's also overdue, so my apologies as we've kind of taken a step back to get going in our own new groove. We've shortened up some things, we've tightened some things, and we've had a blessing in the form of Lucian's joining us here, and you'll meet him very soon. So until next week, I think we've got a lot of ground covered. I'm looking forward to meeting with you at astewardsview.com, and contact us, reach out, ask questions, interact, feel free. Our audio-only episodes are on Spotify and let's see, Amazon and Apple. The video episodes are on YouTube, and so eventually we'll branch out to others like Netflix and Prime Video. But that's where we're at for right now. You can reach all of that content, including the Life Cycle of Wealth book that is, I've been waiting, Lucian. It's been a long go. That's available out at astewardsview.com, and we'll talk more about that. But I'm looking forward to time together the rest of this summer. And until we get together again on our next episode, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.